All right, so ladies and gentlemen, here we are at the PowerOptions page. What we're looking at here is a basic trial account for those of you that are just getting started. I do encourage you, of course, to use the 4 steps that are outlined here. You can download that quick free start guide to introduce you to the tools and how to walk through them. There's a few flash tutorials that are set up for you. We've got a variety of archived webinars, and we host a variety of webinars during the week. And a trial member at any time or a subscriber, you can schedule one of those free coaching sessions with essentially a 45 to 50-minute walkthrough of the site. We'll answer your questions and get you used to the site right off the bat. Okay, so I want to make sure to take advantage of those. All right, so our first questions have come in. I might have to deviate from this in a moment. But this is related to either a presentation that we just did last week or a radioactive trading concept when we use the married put strategy as a starting point where we, I'm sorry, I didn't want to go there. Let me go here. The married put strategy outlined by the rules in the blueprint following the radioactive trading techniques. And this is related, of course, to the 12, we also discussed the 12 different income methods we use to reduce that risk, generate income, and potentially bulletproof the trade. The first question that came in, though, is you used the term REDLine in a recent webinar. On Friday, I compared 3 different limited risk strategies, the married put approach versus what's called a reverse collar, which sort of has a profit and loss chart that looks like this, and at the same time a deep in-the-money strangle, which would look more like this, okay, compared to the 3 there, but in a recent webinar. And I've tried to find a good definition of the term, but perhaps you have a moment to define and suggest the importance of the term. Thanks. Okay. Well, I don't have, this is from Patrick, excuse me. So he wants to know, during this discussion that we had on Thursday, and that is archived for everyone there, and you can access that at RadioActive Trading on our YouTube channel. I might point you to that later on. But we talked about what's known as the 3 core principles which apply to any options trade. And I'm going to stay on this page for a moment, and I'm going to draw, and I know you guys hate when I draw, but I don't have the slides right in front of me, I don't think, to get where we want to go. So yeah, I'm just going to draw it real quick. The 3 quick core principles are, number 1 is proper position sizing. Whether you're trading covered calls, whether you're trading long calls, whether you're doing straddles or strangles for earnings in your account, you want to make sure that you have a controlled risk. If I have $5,000 to invest right now, free capital, and I have a $20,000 account, so this represents, you know, a fourth of my available capital, I don't want to take that full $5,000 and buy calls on Apple because I'm bullish on it. You know, I probably only want to put in 1 or 2 contracts at a time. Okay, maybe 3 or 4, but I don't want to put the full 5,000, all my eggs into one basket. Leverage strategies such as credit spreads, buying calls, even calendar spreads can put you in a position where you've overtraded and you can have large losses. Okay. The second principle is what's known as the at-the-money bell curve. Okay, and when you look at any options chain, doesn't matter what expiration, it doesn't matter what stock, the option that is at the money, closest to the stock price, is going to have the highest time premium. As options traders, what do we know? Is when we're selling, we want to maximize our time value premium. When we're buying, we want to minimize our time value. So the at the money bell curve just illustrates that we want to be buying typically in the money or out of the money. It's reversed for calls and puts, of course. And when we're selling, we want to be selling close to at the money to maximize the time premium. Okay, now I had a discussion about this last week. There's a subtle difference. If I'm doing covered calls on a dividend paying stock and I want to hold the stock for long term but generate extra income, well, that's a specific strategy, or I might be looking to sell out of the money because I don't want to be assigned. So in that case, yes, I am only taking in 30 cents, 40 cents over a week, a 1-month period, or maybe a 3-week period, a very low premium, but I'm just trying to enhance the dividend because my goal is to hold that stock long term. That's a specific approach where you might not want to apply the at-the-money bell curve. But if you're looking to be assigned on covered calls, or you're looking to sell naked puts, you don't want to be going as far out of the money as possible to only get 10 or 15 cents. You want to be close to at the money, but still have a reasonable probability of being assigned. Okay, so this is where the money is when selling, and this gives us the benefit when we're buying. Now, Patrick's question is related to in the blueprint. The radioactive trading work is called the REDLine, what Kurt called the radioactive decay line. What that really is referring to, Patrick, it's a cute and clever name for the time value decay of an option. And the static chart of a time value decay of an option looks something like this. Actually, I'm going to pause the screen very quickly. We'll come back to the screen in just a moment. Do something very, very quickly. Okay, and sorry for my typing, folks. I'll be done in a second. Okay. There we go. Okay, so let's do that. All right, this is the image that I want. Okay, so I'm just going to go ahead and do this now. Let me show my screen again. All right, so what this is referring to, Patrick, here is when you look at the time value decay of the option. So let's say we're looking at a stock such as Apple, which is trading right around 144. We'll call it 145. Okay? Now, regardless of which strike I buy or sell, you know, if I'm selling at the money, I'm going to have the highest time premium, but if I'm selling in the money, I'd have lower but higher intrinsic. But regardless of that, if I sell the 1 week out option that expires in May 5th, I might see a rapid time decay. So I might only get 20 cents, let's say maybe 30 cents, assuming earnings aren't coming up next week, which they are on Apple, but let's say it wasn't. We might only get 30 cents for the at-the-money option 1 week out. Well, what are we going to expect? In the next 5 days, that's going to decay very rapidly. The percentage decay is going to be quick. If I sold the May call at 145, I might get, let's say, $1.50. So in the first couple of days, it's going to decay slowly, but then it's going to go much more rapidly. If I buy or sell, let's say, the June series, it might cost me $2.10. But in the first 30 days that we go through to May expiration, if the stock doesn't move, stays right around 145, and implied volatility remains the same, this might only drop in the first 30 days 50 or 60 cents. Okay, so it might be trading around 150 or 160 here. So this is June. This is the price for the June option at 210. Here we'd be at May, and here's 1 week out. Now let's say I go to July. It might cost me $3.10. Okay, so now, you know, compared to May, I'm, you know, May, June, July, I'm about 3 months out in time, but I'm not 3 times the cost, right? It's not $4.50. But in that first 30 days, as we go backwards in thought, as we go to April to May expiration, now we only have 2 months left here. This might only lose a little bit. Okay, it might be around 270, and then it would drop faster, and it would drop faster. And then, of course, if I buy 5 or 6 months out or sell 5 or 6 months out, let's say we get $4 for the 145 strike. Well, in the first, let's say this is in October. In the first 30 days of the trade, now we get into May expiration, this October option might only drop down to 370 to 360, or I'll call it 350. So I might only lose 40 or 50 cents, and then 60 or 70 cents, and then maybe only 80 cents, and then we'd lose the rest of it very quickly. So it's sort of the decay of the option, the time value decay of the option. That's what the red line is. What does this also illustrate to us? Well, it illustrates that when we're selling, we want to be selling here to get the rapid time decay in our favor. And when we're buying, we want to be buying further out in time. Not only because the decay is less over the first couple of months we're in the trade, but at the same time, the option that is 5 or 6 months out in time will not be 6 times the cost of the near-term option. So that's what dictates to us that why we want to buy a put for insurance slightly in the money, why we want to buy it far out in time. It forces us into proper position sizing. It correctly puts us in the proper spot of the ATM bell curve. And at the same time, it puts us in the proper range, that original insurance, where we're not losing the time value, which is our true risk when using a put for insurance, and having it decay rapidly against us. Sure, the near-term put is less expensive, but at the same exact time, you get what you pay for, don't you? Okay? If the stock doesn't move, you lose all of that time value in a 10, 20, 30-day period. Whereas if I buy a 6-month out option, the first 30 days stock doesn't move, I might only be giving up 20 to 30 cents of time decay on that option, and I still have most of my value in the put that I had originally purchased. Okay, very quickly here, we'll take an example just to illustrate that. Let's go to Apple now, and I will go to the chain, and I'm just going to look at the call chain, even though we were talking about puts a moment ago, Patrick. I'm just going to look at the call chain here. And we've got the small chain. The stock ended today at 143.65, which is going to become relevant for something else I want to cover, and the second question that came in. Okay, all right. So here's the idea, and this is the second question coming in is a discussion I had with Wesley earlier today. Now, expiring today, of course, doesn't count. So let me go out next week, May 5th weekly, and I want to focus first on this column over here, the time value. And when I talk about the ATM bell curve, the stock's at 143.65. So the 144 we'd consider to be at the money. The percentage time value is at 1.6%. That's low because we're only 5 days out in time. All right, now it's at 144. As we go deeper in the money, the time values drop. Now sure, the premium is increasing to 715, 730, but most of that's intrinsic value. You're losing time value as you go in or out of the money. So the sweet spot to sell on the at the money bell curve is in this range here. Okay? Everything else has too low of a time premium. Now, when we talked about time decay, which we can't show, but of course you know this is going to decay rapidly because we're 7 days out. But what I also wanted to illustrate is here on the chain, I'm going to click hold to hold the May. Actually, no, I'm going to do this a different way. My apologies. I'm going to go to standard May expiration for the time being, May 19th. And I'm going to hold that, and then we're going to go out to October. Okay, so I'm going to pull up 2 chains for us. And we're just going to focus on the 144. Now the May series, 21 days out. The at the money 144 call, if I was selling a covered call, is priced at 262 to 268. Okay, so maybe 264, 265. Now this represents, if I sold it just as a covered call, for example, I have about a 1.9%, 1.8% time premium. And of course the price we're going to say is at 265. Going out to October, 175 days away. So we're about 8 times, almost 9, but we'll call it 8 times the amount of time out, right? From 21 days times 8 would put us at about 168, but here we are at 175. The 145 call is priced at around $7. Well, that's not 8 times 265, is it? No, it's only about 3 times as much. Okay? So going further out in time, this decay is going to be more slow. But at the same time, when I buy an option, even though I'm paying $4.35 more for this option, it's not 8 times the price, but I'm getting 8 times the amount of time. The cost per day is lower. That's why when you sell, in addition to taking advantage of the time decay, when you sell, you want to be selling near term, weekly, 1 month out, 45 days out in time. And when you're buying for insurance, for speculation, other than what we're going to talk about in a moment, or other things, you don't want to, I apologize here, you want to be buying further out in time because if you sell 6 months out in time, you're lowering your annualized return. And if you buy 6 months at a time, you're lowering your annualized cost. My cost per day is less at the same strike. Even though it's a higher price, my cost per day is less. Okay? So you see here 21 days and 265, it's about 13 cents per day. 175 days, it's 7, it's much less per day. And the time decay isn't that rapid against you, it's not that rapid against you. It will take more time for this to lose its value. And of course, you can still get the same benefits. The stock swings up and down. All right. So that's for long-term speculation if you're buying a call or put or using a call or put for insurance. How would you use a call for insurance? If you're short stock, or maybe you're using it on a a bearish spread, you want to buy an extra long-term call to protect it, or of course in your diagonal spreads or horizontal spreads as well. Now Wesley and I had a conversation earlier today regarding a strategy that he was putting together to try to take advantage of volatility earnings next week, like on Facebook or on Apple. Okay? And the concern that I had with what Wesley showed me is the original position he sent is he was looking at sort of a, I don't like to use this term, but in my mind this is how I would define it. It was a reverse double horizontal spread. Okay, so typically in a horizontal spread, what am I doing? In a calendar spread, I'm selling a near-term option, short expiration, could be at the money. If it's the same strike, it'd be a horizontal. And then I'm buying one further out in time. So we sort of get this curved tent profit and loss chart. So what is a reverse calendar to try to take advantage of volatility? Well, I want to pay into a lower volatility, shorter term with earnings coming up, and I want to sell into farther. So what we were seeing is a position where we were selling the call and put for next week and buying the call and put for today's expiration, which would reverse this initial profit and loss chart and give us something that looked like this. But the problem with that, in regards to, I think, what Wesley was trying to do, is we were looking at entering in a position today at the 144 strike, and we were going to buy today's options, and I believe the prices were around 14 cents here and about 25 cents here for the 144 put when he sent the trade and the 144 call. And then 1 month out, with earnings I think coming out on May 4th or May 2nd, sometime next week before Friday. I hadn't looked it up earlier, but I've got 3 other trades that have earnings on the 2nd and 3rd, so I forgot which one is which. We were selling a 144 call and a 144 put. Okay? So when he originally graphed this position, what did we see? Well, we saw the profit and loss chart that I showed you. But not only that, Wesley saw the chance for potentially a riskless trade. There's no way he could lose on this position. But there's 2 factors that are missing. Okay? The first factor is that this does not take you through earnings. Okay, the earnings are next week. All this did was give you the position today. These options are now gone. And with the stock at 143.65, remember you had bought a 144 put, which is now 35 cents in the money. So if you didn't close it, your broker exercises this, you're now short 100 shares of Apple at 144 with a short straddle from the 2 options that you sold in this position. This is only showing you the profit and loss at the nearest expiration, only today. This gives you no coverage for next week when the earnings are actually going to happen. This is a very dangerous approach in this structure. Okay, so let's say that that did happen today. Okay, and we ended up being short stock on this position now. So I've got to add that in. Let's add another trade line. We're going to add the stock, but we're going to short it 100 shares at 144. These 2 options are gone. And in addition to that, you lost the 14 cents you paid for the call. So we got to subtract that from the premium here we received from the put. And you essentially kind of lost, well, you paid 26 cents, but you're sort of 35 cents ahead because the stock's lower right now. You could buy to close the stock at 143.65 on Monday. If it stays the same, you make 35 cents, okay? What is this? This essentially looks exactly like a naked call position where you have some profit if the stock falls of $472 on the position, but you have infinite risk to the upside. But let's say you closed out the 2 long options that you bought, Wesley, before today's expiration. I'm sorry, you sold to close those 2 ones there beforehand. Okay? So I clear this out. What are you left with? After today's expiration, what are you left for next week? You're left with a short straddle, which has high volatility. Your break-evens aren't that big. What are your expectations for earnings coming out? If you think this is a high volatility on Apple, which it really isn't, all right, it's about 0.3, by the way. So it might be high for Apple, but it's not really high implied volatility at all on this position. But you're in a short straddle at earnings. This is the exact opposite position you want to be in. Okay? Sure, your break-even's 4 points away, so if there's no news and this just goes up to 145 at earnings or drops down to 141, by May 5th, you'd still have a reasonable profit of $472 on the position. But what are you expecting in earnings? You're expecting a gap, maybe 10%. Okay, let's be nice and say 8%, so maybe $12. Well, that puts you at 155. You had a loss of 527. Or 11, 12 points down, you're looking at 131, a loss of 528. Okay, so most investors who play earnings, even though it's expensive and you're in an increased implied volatility, they'll play it with the long straddle or strangle. Why? Because I'm expecting the swing up to 152 where I'd have a profit of 527 or 131. I'm expecting at least a 7 or 8% move. That's really the only time straddles work in my opinion. And I've been playing 3-day out straddles on earnings and stocks that offer weekly options for the past month and a half. Very good success rate, good percentage rate, but I'm only playing with a small amount of money because I don't want to risk too much. But in order for that to happen, you're going to need at least a 7 to 8% move in the stock. I had one today, or one the other day on Ally Financial, which is also a RadioActive Trade I'm in, and it moved about 3 or 4%, but it was just enough to break even on the straddle. I needed the 8% to get close to the profit I wanted. If it surprised me and went 12% one direction or the other, it would have been a fantastic trade. But that's the idea. Okay, so what's the problem? The problem is I'm paying into high implied volatility, and I know it because I'm more focusing on the stock swinging. I know I'm going to have a volatility crush. That's inevitable with the earnings coming out, but I'm only doing it on a stock that I think is likely to have a wild swing based on past earnings and based on its current performance to gauge what would happen. Okay, that I need that 7 to 8% move to make the straddle worthwhile. I'm going to suffer volatility crush. I have to accept that. Okay, you want to sell, Wesley. I see that. You want to sell. Your plan to do what you did when you showed me the trade today of the 28th of May, did you know, or 28th of April with the 5th of May, did you know good? In my opinion, because you were short these two options. Okay, you're in a straddle, a short straddle, which is just a naked call and a naked put, and you have infinite risk in both directions. Okay, so if you wanted to do what you were asking to do, take advantage of implied volatility, maybe you're selling this near term, but then you're buying, completing your calendar, going further out in time, a couple weeks out or maybe a month out, where it's still high prices, but maybe the volatility won't affect those options as much. You might even need to go 1 or 2 months out. So it's, again, a diagonal. It's not the strategy you wanted. How would you get the risk profile that you showed me in the email earlier today? We'd have to do the same thing, but to take advantage of the volatility crush, the options you're selling have to be past, have to be beyond the earnings. Otherwise, it won't give you any advantage for what you're looking to do. And it's not a trade I would do, okay? But it's what you're looking to do, I guess, by what you sent me. So I think what you're probably looking at is selling these Mays, if you want to take advantage of it, and then also buying the same expiration, maybe creating a diagonal spread or an iron condor. But again, if you did that, that still puts you in a position where you're overpaying, okay, into the position. Oh, I'm sorry, let me clear that one out. I don't want the 149, I want the 148, my apologies. But you're paying higher for these out-of-the-money options, but you're still getting a reasonable credit. But remember, if you're in the same expiration series, just going out of the money isn't going to change the fact the implied volatility, it's not going to make the implied volatility lower. Okay, the implied volatility will be lower compared to the at-the-money, but it's still going to be higher than it likely ever has been because earnings are coming up in 3 days, and you're selling and buying options that are 5 days out. So if this 144 at-the-money strike that you're looking to sell has inflated implied volatility, so is the options you're going to be buying. Okay, but let's look at our iron condor, or this is a butterfly. Is this a good trade? Well, still a very tight risk. In order for you to reverse what you want to do, what you're looking at here, and take advantage of the earnings, Unfortunately, what you're going to have to do is your structure, but you're going to have to be buying the options that are going to be most affected by the earnings and then selling ones that are past that. So the expiration date would have to be past the earnings to take advantage of it. Buying the April say, did you know good? Because their earnings are next week. So you enter into this position, but yeah, you're going to end up with a chance for a loss here, and your swing is bigger than what you saw. Some investors will do strangles, out of the money strangles if they're looking for the implied volatility. Where do they set their fences? Well, they set their fences based on where they think the stock won't go. So if I don't think the earnings are going to be more than an 8% movement, and I set up to about 151, well, they might sell a 152.5 call and maybe sell a 134 put. Again, this is not a recommendation. It would have to be based on what your expectations are. So I can't sell at the money to get the most premium. That's a worthless trade. No one would do. All right. The monetary requirement's too high, but my break even is 133 to 152. Okay, so the advantage isn't there. So you can do double diagonals in the calendars, but sort of the reverse of what's going to happen. Sam's got an interesting point in relation to this. That's why I was scanning through the questions here. Pascal, I'll get to your questions in just a moment. Sam says, I like to wait and see next morning. The options are cheaper due to a directional trade 4 weeks time frame. So what Sam's going to do is not try to take advantage of the implied volatility coming up, because as you just saw, let me go back one step fundamentally. I have a webinar here. I'll come back to the screen in a moment. But I have a webinar here under the options concept section. Now remember, everyone, this is a public page. Our webinars page here is powerop.com/webinars.asp. Okay, and in the options concept section, I have a webinar, older webinar, about 45-50 minutes long, called Implied Volatility, the Double-Edged Sword. Okay, and I encourage you to take a look at that this weekend. What does it mean? It means that as investors, you've probably come across free information or someone selling you a product or something along those lines that said, hey, you can't be successful in options trading unless you sell into high implied volatility and buy into low implied volatility, or buy into low volatility. Well, that's bunk. You're probably going to lose more if you're trying to sell into high implied volatility, and we just saw that. If my goal is to say, hey, I want to get a lot of premium by selling calls and puts on Apple before its earnings, well, we saw the profit and loss chart. You have an infinite chance for loss in the upside and downside. If there's an unexpected move and it moves more than 10, 12, 15%, you're going to have a very significant loss because you sold into implied volatility. Sure, you had a little bit of an upper and lower break-even range, but that can be breached very easily. Why is the implied volatility high? Because of earnings. So do I want to be selling something, a directional trade, a straddle, naked call, a naked put, even a bull put credit spread or a bear call credit spread when earnings are coming up? No, because I've essentially set myself up for a 50-50% chance that I'm going to have a very large loss. If I did a bull put spread on Apple right now for next week, thinking it's going to be bullish, and saying to myself, hey, these premiums are rich, I want to do a directional spread trade, I'm going to sell that 143 put at 214, and I'm going to buy a 138 put for 68 cents, let's say. This is a standard bull put credit spread, higher than I'd normally be able to get, a net credit of 145 for a risk of 355, a 40.8% bull put spread. I mean, I'll never see that on a 5-day out trade on Apple again. It'll be 25 cents or 30 cents for a 5-point risk. Okay? And that's what you'd expect because it's normal. This is not normal because earnings are coming up. My max loss occurs if the stock falls below 138. I start to get a loss if it goes below 141. The stock's only at 143.65. Now, I'm not going to bet money on this as we trade, and we're talking about straddles, which is essentially betting on a wild swing one way or the other. But I'm going to say that I don't know which direction it's going to go, but I bet you it's going to move more than $2.10 after the earnings. Now, it could gap up and go to 150, and this would look like a genius bull put spread. Or it could gap down and go to 137, and I've taken the full loss on the position. So, is looking for high implied volatility. Why does something have high implied volatility? Because an event's coming up and there's more risk. So is that something where I want to be selling premium, selling credit spreads that are directional, even iron condors that are quote-unquote neutral, but they're not neutral. I mean, they're neutral and you don't want the stock to move, but it's not neutral in the sense that if the stock goes any direction, you're going to have a profit. It's the opposite. You're going to have a loss if it moves too much one direction or the other. Okay? So how do you want to take advantage of it? Well, what do you know? The stock's going to move one direction or the other. The profit and loss chart you put forth did kind of take advantage of it. It's like that reverse collar. You'd have to be buying the options that go through earnings and selling the options closer in. And as we saw, when you sell the options further out in time and you're buying the options next week that are most affected, it will give you this V profit and loss chart you're looking for trying to get income and generate premium, but it was at a loss. You won't have the gain. Why did you see a gain today on the position that you had? Because it was only looking at today's expiration. It's not looking past that. Whenever you put in any tool, you also sent me a picture from your broker's tool, and it had the same risk-reward profile. It's not looking at the position for the next expiration. It's looking at the most current, which was today. Okay, so when those two options that you bought today disappear, the options that you sold that are further out are still there, then you've got that opposite profit and loss chart, the A-frame profit and loss chart, with a large chance for loss to the upside and the downside. Okay, all right. So follow up with Sam says he's wait for do a directional trade 4 weeks time frame rather than wait for the next earnings report. And that's sometimes something to take advantage of too as well. Okay. He says he's in Facebook from last earnings, the earnings before on Facebook, and he's got from at 130, he bought stock plus options 6 months away at 150. Okay, so he's in a protected position now going into this earnings. He's $200 up with some other things as well. All right. So now Pascal's questions. We want to get into some of the tools there. So I want to encourage you, Wesley, remember, go to the webinars page there, powerup.com/webinars.asp, and take a look under the Options Concepts tab about implied volatility. I agree with you. I mean, what I said before in relation to implied volatility and selling it, you can be successful selling into high implied volatility. Don't get me wrong. Okay, but remember, when you're selling a call or a put, you're setting yourself up for direction. If you're selling two at the same time, it's still, in a sense, a chance to lose if the stock moves one direction or the other too soon. Scariest thing I ever saw in my life. A customer called me up a year and a half ago looking at a $10 stock, and he was selling the 11-strike call for $3 and the 9-strike put for $2. So he's in a straddle where he's getting 5 points of credit. Okay, so he couldn't lose unless the stock fell below $4 per share, or if the stock moved up above, what did I say, the 11 plus the 5 is up $16 per share. It was on a biotech stock that had a phase 2 or phase 3 FDA approval coming out in 3 days. The stock dropped to $1 per share and then continued to go down below it. Essentially, the implied volatility disappears. There's no premiums to even try to roll the position. The stock's going bankrupt. He did 50 contracts of each. So essentially, what does that mean? It means he sold 50 puts at the 9 strike. And even though he collected $5, he essentially had to buy 50 contracts, or, worth of stock, 50,000 shares of stock at $9 for a stock that was trading at $1. He did receive $5 in premium, but the amount of loss was ridiculous. Okay, that's the danger of overthinking it and selling into too high implied volatility. Okay. Pascal, I'm going to take your second question first here. Pascal's question says, can you scan for high dividend stocks? Absolutely, using the PowerOptions tools. Now, the only strategies you're probably going to be looking for high dividend stocks, I'm assuming, would be for covered calls, married put positions, or collar positions. Okay, but in any of the strategies, it's the same place. So let me go into married put here. I'm going to have to change some settings. So here's the default criteria that we use, the results we see for the default criteria that we use for RadioActive Trading. 95% of my trades that I post in the Fusion subscription that are my real trades are from this search criteria following the RadioActive Trading techniques. But to do what you want to do, Pascal, if you're doing it in a married put, we've got to change some things. Okay, now first off, we'd leave this 150 to 900 days out. We'll lower the risk because we're going to have a much lower chance of, much lower premium with the high dividend stocks, meaning volatility. But we'll put 1 to 9. I'll keep this range. But I got to change the technicals. Number one, any high dividend stock, and to me a high dividend stock is pretty much anything above 6% or 7%. But a stock that has that high of a dividend is not going to have this high of a stock volatility. So I might only look for, I'm not going to look for anything, to tell you the truth. The dividend's going to take care of that. But I'm going to leave the stock price trading above the SMA 50. I'm going to leave average stock volume at 300,000 shares. I'm going to leave my stock price range 9 to 200. Okay, I'm going to take out the EPS growth. And the last thing I have to do is take out the list we use. Kurt, Ernie, myself typically prefer for this strategy to look at the IBD 50 CanSlim lists. They will not offer any high dividend stocks. It doesn't match their criteria. So I'm just going to go no lists. We're going to go back to fundamentals. And then it's very simple. In the fundamentals, percent dividend yield. Put in what you want to see. I'm going to put in 7% or greater. All right. Now, Pattern Energy Group, 7.5%. Enbridge Energy Partners, 12.6% dividend yield. Okay. My risk is pretty high, though. It's a 2018 January at 266 days. Risk of 8%. Okay. So what does that mean? This put is only 266 days out in time. To get the dividend of 12.6%, I probably have to be in the position for close to 360 days, right? Every quarter. Now, so I know that this isn't going to cover it, but this position here, I'd consider a high risk. Why? Because the dividend is priced into it. Let me show you what I mean. Stocks trading at 1934. We're looking at a January 22.5 put that's priced at 520, which carries a risk of 8.3%. Okay? Similar stock that doesn't pay that high of a dividend, or any dividend as well, in 1 second here, would be, I'm going to go to the search by symbol tool, would be, again, one of the stocks I'm in that I mentioned, ALY. It's around 1960. Let's go to January expiration, 267 days out. Okay? And let's see what we've got. Do I have a 2250? No, I have a 22, and that's only 5.6%. Why? Because it's only a 1.6 dividend. That higher price dividend is priced into it if you're doing a married put. Okay, Pascal, that's just what I want to show you. So, to answer your question, can you use it for high dividend stocks? Yes. Any of the strategies you go into, oh, I'm sorry, let me go back to the search. You want to go into the fundamentals and just put in what you want for the dividend. But at the same time, you're going to have to change your criteria. What do I mean by that? Well, I already showed you how I had to lower the volatility here. But let's say you were doing a covered call. I don't have it here on my screen. I can't believe that, but that's okay. Let me take out Iron Condor. Let me add in covered call very quickly. The available strategies that we have. So anytime you don't see a strategy you want, remember, click on Other Strategies, remove a strategy you don't want to see, and go into covered call. Select the strategy you want. Okay, so let's say you're in the mood for covered calls. You want to trade 1 month out at the money covered calls, Pascal, and you want to generate a 2% return, but you want it on dividend stocks that pay 7%. What's the easiest way to set up that search? Well, you already gave me 3 or 4 criteria that's already going to narrow down the universe of options. I know I'm inventing them for you, but here's what I would do. I hit clear filters first. I'm going to set my expiration time for 8 of May. I want my return if assigned to be about 2%. I could say my time value, my percent time value, the at the money option, I want to be 2% for this 21-day trade. And I want to have at least a good 3% downside protection. But you know what? I'm going to leave that out. I'm just going to say I want a 2% time value, at least a, let's say a 2% return if assigned. Not worried about option price, but I want something to have at least some option volume today and some open interest. And I only want to see stocks that pay a dividend of 7%. So I go to fundamentals, percent dividend yield, and let's go ahead, oops, sorry folks, and submit that. All right, what do we get? Oh, 3 times and 4 times ETFs. Too much volatility, not a position for a covered call or a credit spread in my opinion. I don't do them. So let me go to the lists, and I'm going to exclude now inverse ETFs. Now I'm going with the leveraged ETFs. I want all the 2 and 3 times ETFs out of there. So let me submit it again. Okay, I'm surprised. GNC Holdings, 7.78. May 7.5, just in the money strike at 60 cents. Well, for the stock, it's a 4% return. The dividend is 10.1%. But what's interesting here is the last ex-dividend date was back in December. I'm going to have to look at that. I'm going to jot this one down. GNC, they might have canceled their dividend. Okay, so let's go to the next one. 329. Well, the dividend isn't going to be until 629. We don't have any that come up, okay? So when none of them have ex-dividend date between now and expiration. Because if they did, the premium would be lower, which is what I wanted to illustrate. But that's the process. Now, going forward again, your second question. That's how you can set the dividends. The answer to your question is yes, and that is how you look for high dividend paying stocks, okay? Now, going forward on that, your second part of the question is what can we look forward to? How do we use the criteria to look for stocks that are surging before they surge? I don't have a guarantee for you. No one does. Sorry, folks, needed to wet my whistle there. So how can we scan for stocks before their surge, either up or down? I'll show you what I try to do, okay? And I use this for my own personal, other married put screens as well, but I'm going to keep it in the covered call screen. No, I'm not. I'll use married put. It's close enough to a long call. I was going to say long call, but you know what? No, I want to do long call. I'm going to do long call and long put. That'll be easier. That's what you're looking for, probably. Let's get rid of covered combo and covered call again. Let's add in long put and long call. Okay, so I'm looking for a stock that's going to have a run. Not an immediate run necessarily by earnings, because in that case I want to play a straddle or strangle. In case I'm wrong, I play both sides. Let's say you're looking for something that you feel might have a run up in price over the next 20 to 30 days. Okay, here's the criteria I will use, and it's also discussed in a webinar. I'm going to go to long call, and I'm going to go to the search. Okay, now I'm going to clear the settings as we did before. And I'm going to look for calls that are at least 2 to 3 months out in time. So I'm focusing on June or July. And I could use a time frame. All right, so I'm going to use a time frame of 45 to, what was that? 84 days. Let's do 45 to 85, 45 to 90. It's a good range. All right. I'm going to limit it to be no more than 2 strikes in the money and no more than 2 strikes out of the money in this case, okay? And open interest, I want to see some activity. Option volume today is 0. I'm going to do the same thing I did before. I'm going to do something a little bit different. In the list field, you can create your own list and you can combine existing lists. I have a combined list that I use to remove ETFs from standard searches. ETFs to remove from standard searches. What is this? It's the leveraged ETFs that I showed, 2 and 3 times ETFs, which, to tell you the truth, maybe I don't want to remove it. It might be a good play for a 3 times or 2 times bull or bear ETF. But I typically remove the 2 or 3 times, and I'm removing the inverse. What I mean, if I'm looking for long calls, and because I'm bullish, I might not want to see SH if I'm bullish on the market. That's an inverse ETF. Even though its technicals are where I might want them, if I'm expecting SPY in the market to move up, SH is going to drop. Don't want to do a long call. So I'm removing all inverse and leveraged ETFs. Okay. How did I do that? Well, I went into create and modify lists, and then I went into combine lists, and I just checked the boxes there, scrolled down, and I checked the box for inverse ETFs and leveraged ETFs, and I created my own list. Okay, so you can combine lists at any time or create your own personal list, of course. All right, but to your question, how would I do this now? I've got the general options criteria set up, and I may even choose to go 1 result per security. We'll do that after the search. Fundamentals I'm not too worried about right now, but this is a long call. I may put some basic things in that I want to see stock that has a reasonable growth. I may want a stock that has a reasonable market cap. This is mid to large cap, greater than 2,500 or greater than 2,000. I'm looking for mid to large cap stocks. Okay, so I don't want to see any small companies. Personal preference, don't have to put that in. Let's go to the technicals. The Bollinger Band ranges and the MACD as well as the SMA 20 is something I typically look at, but I'll look at the SMA 20 later. First thing I want to talk about is the percent bandwidth, okay? We're going to look at what the Bollinger Bands are, but essentially the Bollinger Bands are an envelope that goes around the stock, all right? And when you see a Bollinger Band on the upside, if the stock's trading near that, it's considered at 100% of its BB20. And if it's near the bottom, it's at 0%. But the width is going to change based on volatility and based on movement. What do people who look for a breakout look for? A lot of investors I talk to tend to look for, they want a stock that's channeling or condensing. So I want the bandwidth of my Bollinger Bands to maybe between 40 to 60. I want it to be in a tighter range. I'm sorry, I want it to be in a lower range. That's something different. That's for the BB20, okay? But I might want it to be less than 20. Okay, the bandwidth, the width between the two bands, I want to be a smaller percentage. Now, I also tend to look at MACD. And what I'm looking for in MACD is, if I'm bullish now, I'm in long put. Or, wow, sorry folks, it is Friday. I'm bullish, I'm in the long call search. So what do I want to see? I typically want to see something that's just had a recent crossover on the MACD line where the MACD has crossed the signal line. Again, a different trend. So I'm going to look for stocks that have just crossed over within the last 2 or 3 days. Okay, where the MACD is just above the signal line in the last 2 or 3 days. Okay, that's what I'm going to look for. And this positive and negative here, I'm not going to worry about. I'll explain that in a moment. Now, this works for me sometimes, doesn't work all the time. The market dictates it not be. But let's go ahead and run this search. Let's see what we get. We got too many results, 146. Well, Priceline, of course, is up there. Allergen, Equinix. But let me go ahead and click this one result per security. I might even narrow this further down, so I'm just looking for in the money or out of the money. I don't know what strategy you're using, I'm saying in relation to a long call. All right. Now, so what does this all mean? Let's take a look. I'm going to go to Priceline. We see here that the percent BB20 is at 134. Might have missed this one. The bandwidth is 5. Okay, so let's go to Priceline here. I'm sorry. Let's go to Big Charts. Now, I customize Big Charts. Usually, I didn't save it from a last webinar. But here's what I typically set up. Ernie uses a 3-month chart. I use a 6-month. Doesn't matter, but, you know, personal preference. Now, in the indicators, what do I want? I want to select the moving average of the SMA 20. Now, normally in a long call, I'd look for stocks that were trading above that. But the reason why I need the SMA 20 is because I want the Bollinger Bands because I screened for them. And the Bollinger Bands are based on that 20-day calculation. I'm using MACD, so I might want to use that, as well as the RSI, Relative Strength Index, and the volume. There's other things you can set here, fast or slow stochastics, William percent R, volatility fast, slow, percent short interest, things of that nature. I just use volume as my last one. Okay, let me go ahead and draw the chart. Okay, so this one, to tell you the truth, I might have missed. But these, let me go to knock on wood, Ernie gets the best of me again. He's not even on the webinar. Let me go to a 3-month chart so it's easier for you guys to see. This is what I look for. Whether it is below what's called the signal line. This black line here is the divergence line, excuse me. But whether I see a MACD crossover where the blue line is crossing above the red line, either below the divergence line or above, that's what I'm kind of looking for. Okay, and then I want a stock that's just recently popped above the Bollinger Band, what's called a Bollinger Band breakout. And it looks like Priceline had it. And now I know it's expensive, but is that relevant? Well, look here. When was the last time we had a MACD crossover and a break over a Bollinger Band? It's right here. Break above the Bollinger Band, so it was around 1750. Now it did settle, but then look, went back up again, and that was after a channeling. Okay, it was kind of condensing there, and then it popped up. This was probably due to an earnings event, I'd guess. But then look, of course, we went from 1750 up to 1800, it condensed again, and now it broke out. So this is what I look for as a stock to surge. Now, did I miss the initial surge? Yes, but I'm looking longer term. And again, I'll tell you the truth, Ernie uses this as well. We saw what we called that Bollinger Band breakout. It broke above the upper band and then closed above it 1 or 2 days. Then we expect, when we see that, I'd expect this to maybe stagnate, but then continue up based on these technicals that I'm looking at. Let's take a look at another chart to further illustrate this, okay? Now, this is directional. Now, if you want to play just a I apologize. If you want to play an earnings event, of course. Oh, shoot. Sorry, folks. Let me store the chart settings so we don't have to do that each time. All right, fantastic. Now, let's go back. And let's look at Equix. Now, I want to look at something smaller. No offense. Oh, Papa John's. I almost traded that a little while ago. I'll just take a look at it. Now I'm hungry for pizza. I think I'm going to have my wife order pizza when I get off the line with you guys. I'm not sure. All right, let's go. Okay, so this one here, we're going to have to go to a slower chart. I'm sorry, a lower time frame, because we almost can't see the MACD line. And it's still hard to see, I know, but here it looks like it just recently crossed over. Very hard to see, I know, but the blue line has just moved above very lowly, and it has just moved up above the 20-day moving average, so it closed below it. It's channeled. This one's questionable to me. It's not giving me as positive a signal. Okay, I like this stock. I have liked this stock before. You can see it's pulled back recently. It's down 103 today. Nothing after hours, of course. But it did just recently cross over. It is condensing. Might want to break one way or the other. This might be a question, by the way. I think someone just chimed in and told me this. My apologies here. This might be channeling here, okay, as earnings are coming up. Let me take a look here. Yep, 5-2. Okay. Does this stock offer weeklies? I'm sorry, I know. Let me go to the option chain real quick. No weeklies, okay. Kind of expensive. All right. I'm thinking about a straddle or a strangle on this position now that I see it with earnings coming up on May 2nd based on how it's been performing, but okay. All right, so that's what we're looking there. Now, I'm doing this in the long call, Pascal, but it's the same thing in the married put. Okay, you could change the criteria just as I showed you. You'd go into the radioactive search again, leave the criteria here since you're bullish, and what I'd look for again, I'm sorry, I'd leave everything here alone, and then I'd look for crossover of the results that are here within the last 2 days. Bollinger Band less than maybe 20. Okay, take a look. Gray television. I saw Sinclair Broadcasting in here earlier. I don't know if it had the results I'd look for. This thing is middling about. It's very close. I'd be curious on this one because it just dropped today, 65 cents. If that was based on earnings, if earnings came out today, I wouldn't touch this one. Okay? All right. So, for those of you that are interested in doing this kind of screen, I'm sorry, for other strategies, such as long puts and bearish, you do the same thing but reverse it. You still want something that's condensing, but then with the MACD, instead of looking for one that is recently crossed over, you might want to consider looking for something that's crossed under within the last 2 days. And of course, yeah, Bollinger Band may be less than 5 and less than 20. Now Ernie's here looking at the percent BB20. I should have shown that, and I'll explain where that is. Hibit, some lower price public storage. It's an interesting one, isn't it? Let's take a look at public storage. All right. Oh, that's why. And okay, it's because of this. Okay, so this one might have been one we missed, but it looks like it's still breaching downwards and it's got some issues. Okay. But here you see it was starting to cross over, it was approaching. When was the last time it had a negative crossover? Was here. Okay, so right about here, and then it dropped down, but did come back up, but then it stayed down here. So it didn't quite get the full breach. But that's why, when you're, in my opinion, when I'm trading long calls and long puts, if I get in because of a MACD crossover, I typically get out when I start to see the other one, if I haven't gotten out already, if it hasn't hit my other triggers. Okay? All right, so, but that's how you would set it. You can use the MACD there to look for over or under, to look for positions that have recently crossed over or under. It might be more. Of course, we saw this one here. That one we looked at was because of a breakout because of earnings, but it might be different later on. Okay. Isaac says, does follow the crowd trade work? NBC discusses unusual option activity on some stock. Most of the time, trader buys thousands of out-of-the-money call options 2 months out. You don't know that, okay? Does this type of trade work? I did a trade on that like today, and CL gapped down after earnings. Right, because you saw out-of-the-money call option volume. Were you sure they were buying, Isaac? Remember, when you see volume, unless your broker specifically lists that it's buying or selling, You can't just look at volume and say that it's buying. It could be selling, in which case the person was giving themselves cushion and was betting on the bearish move. Okay? Does following the trade work? I mean, I don't know, to tell you the truth. Unusual option activity. Let's take a look. Oh, Sam was just saying he was in there for that as well. Okay, Sam's offering his opinion. Going back to, I almost said, sorry, I watched the Spaceballs last night. I almost said Pizza the Hut. Looking at Papa John's PZZA, he said looking at that chart that we saw on Papa John's, he's actually selling close to the 65 puts, considering selling the 65 puts. Okay? All right, so let me go back up here. Unusual option volume. Isaac, when you're in earnings season, throw everything, I don't like to be this frank, but when you're in earnings season, throw everything out the damn window, to tell you the truth, okay? You said, I'm sorry, it was CL, I believe you said it was. Maybe I read that wrong. You said CL. Okay, and you got into that. It's down 126. You might have traded it earlier because you saw unusual option volume, probably due to earnings. Okay, and it dropped down 126, probably because of the earnings. Yeah, unusual option volume with a stock that pays earnings is because people are gambling one direction or the other. It doesn't mean the person's going to be right, my friend. All right, Isaac, it really doesn't. So to me, if you see on CNBC that someone has high option volatility or high option volume on CL, and it's because earnings were coming out today and you saw 1,000 contracts of a specific strike traded yesterday, the first thing I do, okay, let's say for, I don't know if it was for this weekly series or next week, but let me go to this week. I got volume. Out of the money is not that much activity. Let's go to yesterday before the earnings, okay, for today's expiration. This stands out, doesn't it? 350 contracts at 79. Now, I know we don't have the data. I'll admit it freely. I don't have the data here on this particular position to know if this is buying or selling. We don't have that at PowerOptions. But something, when I see this, something sticks out at me here too. I see this big mark at 350 here. I don't know if it's selling or buying. I can't imagine people would be buying the 79 thinking the stock would have gapped up to 80 for earnings. Possible, but I doubt it. I think more what was happening is this number of 152, some of this number of 154, and some of this number of 150 is included in this. What do I mean? If someone's buying this many 350s, well, it's probably part of a bear call credit spread where they sold some here, and sold some here. So they've got maybe 300 contracts traded against the 350 at different strikes, betting the stock was going to fall. It's a possibility. What is another possibility? Well, another possibility is that it was reversed and someone sold these 350 for a measly premium of 10 cents, but it's a good amount of money because they didn't think the stock, even if it had positive earnings, would get anywhere near 79 and these would expire worthless. Looky here, 22.51 and 10.47 on the puts. Much more activity than the calls. Okay, is that buying? Is that spreads? Is that selling? Thinking the stock would stay above the strike prices here at 72.50 and 72. Is it buying puts to protect stock holdings for fear of earnings? I don't know. Okay, but I'm sorry, if it was CL that you were in and you saw it on CNBC there, in that regards, then I would have focused much more on this activity. What CNBC said, oh, there's unusual activity in the calls. There's much more unusual activity on the puts, okay? So if you think that unusual activity in the calls means it's automatically bullish, I would have researched this and saw this activity and said, well, if I think just because more activity on calls means bullish, then this means bearish, okay? Now, it's not going to justify it every time because I don't know. This could just be a spread. This could be people protecting their shares, okay? And we go to current. That's the 72.5 at 65 cents. 72.5, 34 to 70. If I sold those puts, I would have been in the money. They're part of a spread. I would have to buy them back for a little bit here. 72.50 strike today, depending on what my spread was, okay? All right, so I don't think following the crowd is necessarily a good idea. And here's the thing. I see email too, just like you guys, okay? in the sense that I've signed up for services. When I first started working with Ernie, I signed up for competitors to see what they were doing. I signed up for the Yahoo groups, people giving advice to each other so I could offer my opinions too, okay? So I see these kind of spam emails that you guys get too. Hopefully you don't consider mine are spam, but I get spam emails with unusual options activity in XYZ, ABC, DDF, XYZ. Could be anything from someone betting long term to someone playing near term. I will never play a directional strategy. No matter how much I like the stock and how positive I am, I will never just buy calls on a stock that has earnings coming up in 2 days, and I will never just buy puts on a stock that has earnings coming out in 2 days, because I'm taking a 50-50 shot that I'm wrong. I don't know what's going to happen with earnings. No one does. I have 2 stocks that came out with earnings this week. One beat expectations and dropped. One missed expectations and rose. So go figure. I was in married puts on both of them, positioned well for both of them, and so I wasn't too afraid. But I mean, that's the inevitability. Okay, so if I've got earnings coming up on a position, okay, and I'm interested in trading it, I'm trading it as a straddle or a strangle, or as a question I'm going to answer right now. Sam says, what do you think about SQ as a potential for married put with earnings coming up on 510? Well, one of the things I would do in the blueprint, of course, is I don't know SQ at all. I don't know what risks I'd have. I don't even know this stock. But okay, let's say Square Incorporated, 1824. I'd still set it up, Sam, the same way I would set up any radioactive trade. I'm focusing on September, December. In general, I would go with December, but if it's a quick play, I'm going to go with September. Why am I going 140 days out if earnings are coming out tomorrow? Isn't that just a one, quick month play or this month play? No. Because if Sam's doing a married put, he's still likely interested in buying the stock and owning it for other benefits. So why not go 49 days out? Because at 140, what did we talk about earlier? I'm going to get less time decay. I'm going to put time decay on my side. I'm going to go slightly in the money to get a reasonable risk. And if the stock doesn't move from the earnings on May 10th, I'm already in the put option that costs less per day, that's going to cross another earnings later on if I hold it that long. 260 to 290, let's call it 275 at midpoint. I don't know if this is the structure I would use, of course. I'm just saying that this is probably where I'd look. 4.7% risk. I like that. I might even go with the 19 if it was under 8%. Okay? But what I may also do is, Sam, you do this anyway, and you have your own way of trading. I might buy 2 September 20 puts at 275. Why do I want to increase my cost basis? Because that's only relevant at break even. Yes, I doubled it, tripled it to 15.8%. But 2 puts that aren't going to go to zero because they're far out of time on May 11th. If the volatility remains the same, not much of a chance for risk here on May 11th. $26. Even if it stays right around $19, 18 to 20. Okay, so what would I do if the stock just went up to 20 and I had a loss of 26? I'd sell to close one of these. I'd probably sell a 20 call or do another spread position on it. Okay, so that's the structure. You could do it just as this. There's nothing wrong with doing 1-to-1 in this case, because even if the stock gaps down 10%, the worst possible scenario you could lose is 4.7. And if it gaps up, you're in a pretty good position. Okay, that's what I like about trading it. All right. Oh, Isaac, I answered your question without answering your question, without reading your question. I answered your other question that I just saw here without doing it. I already said it. What is your strategy for trading Apple and Facebook earnings? I typically won't trade them. Okay? Again, why not? I already talked about that if I'm playing a position for earnings, I'm doing a straddle or a strangle. I said earlier in the presentation that in general, you typically need at least a 7% to 8% movement minimum on the stock for a straddle to strangle to probably hit the profit that you want. Okay? Apple and Facebook have had good earnings. They've had large earnings. I don't know if I feel confident that either one of them is going to swing 7 to 8% one direction or the other, or if I'm expecting a big enough surprise on those stocks to see it move 7 to 8% one direction or the other. So I won't trade them for earnings. If I miss the boat, I miss the boat. That's fine. I'm okay with that. You know, we talk so much today about how can I take advantage of earnings? How can I take advantage of earnings? And I'm not trying, I might sound like a broken record. I may have come across as a little bit arrogant or a little bit rude with the way I've been answering it. But look, if you're planning on trading earnings on Apple, what are you trying to do? You're trying to take advantage of, I think the stock's going to swing wildly. What are the strategies that are going to be advantage to you if the stock swings wildly, one direction or the other? Well, you got to position yourself to profit in both ways. So you're talking about a straddle or a strangle, or a radioactive trade if you're willing to invest long term that I just showed for Sam with the extra put added, position for earnings, and then manage it later for longer term growth. You know, I just don't know if this is worth it enough. Honestly, just buying one contract a piece of $500, I will never risk more than about 2 to maybe 3% of my total portfolio value on a straddle or strangle. So what does that mean? That means right now if I'm trading with a $40,000 account, I'm probably only doing one contract of this at the money straddle, maybe two if I'm pushing it. Okay? I don't want to go beyond that. Because why? Because if nothing happens, what's going to happen on May 2nd? Okay? Let me show you something here. Here's something that you want to be wary of. For all of the options that we offer, you can go into the option research tool from the more information button on PowerOptions, whether you're on the chain, whether you're on the search tool, or whether you're on the chart. And this shows you the percent implied volatility range and the total implied volatility since the option was released in the market, and you can graph it too. So in general, what am I seeing here? This thing doesn't move from 0.22, 0.23 until we get 3 days, 4 days before earnings. Now it's up to 0.31. It's at 88 percentile of its applied volatility range. I know I'm overpaying into this because I'm planning on the event, right? I'm planning on the wild swing, so I got to pay into the higher implied volatility. You say, okay, well, if these cost too much, Mike, why don't you sell options to take advantage of higher implied volatility? Okay, so let's sell the options that are going to be affected. And again, I might sell the 142 put and the 146 call because they have high implied volatility. What does that do to my position? It reverses the idea of what I wanted, right? Now I can just make a little bit of profit here and a little bit of profit here. That's not doing it. Okay, so why not sell the two right at the money that have the highest time value and buy the ones further out of the money? That's not what I wanted. I want to profit this way and this way infinitely. True, it's a very low risk butterfly here, it looks like, okay, in this case, but your break even's 142 to 145. 1 point away in either direction. You're coming up to earnings. You're going to have a swing one way or the other. So you're setting yourself for an 80% probability that you lose 7% with a 10 or 15% chance you might make 193. Is that a good trade? I don't think so. In my opinion, I don't like those odds. I really don't. So that's why I'm talking about the straddle and the strangle. I know I'm overpaying into it, but because I'm playing earnings, so I'm expecting a big move. That's where you take advantage of it. All these rough and odd combinations you can do of double diagonals, double horizontals, selling into near high premium, buying into farther out, lower implied volatility. You create a direction when you do that, or you create a neutral position like we're seeing here. That's not something you want at earnings. You want that V profit and loss chart, and you could do it. As we looked at with Wesley earlier, I could sell these two and then buy something that in general has a lower implied volatility. But I got to go back to this straddle in a second though. But I could do this here, buy these two further out and have an expensive position. But look, okay, it's a reasonable range of profitability. And if in the first week the stock swings down one way or the other, I have to manage that short call or the short put, the 144 call, the 144 put, I still have a long-term put and call to play as a calendar going further out in time. I don't think this is the best way to play it, but it is an idea, okay? But I don't like it because I want to be the opposite. I want to be this way. Now, that whole implied volatility discussion I just went through here, the average implied volatility, we're at the 88th percentile, and it's usually around 0.17 to 0.2. Okay, how is that relevant? Okay, well, let's go back. We were talking about buying this, and I know I'm paying into extra implied volatility. And I see here that I need the stock to be at 138.99 or 149, 6 points up or 6 points down to break even. But I also know the day after the earnings on 5/3. Okay, I'm sorry, this one's using it. It's using the volatility of 0.202. See, it's not going to keep this volatility of 0.320, where it looked like I had let's say the stock moved up to 149. See, with a volatility of 0.320, I'm looking at a high profit, but in reality, what do we know? As I said, this volatility is going to go back to normal, so I'm at no gain or no loss right at the break even. Okay. Okay, Isaac, you said you did a covered call. Yeah, covered calls are tough with earnings coming up. I would add an out-of-the-money put to collar that position. Okay. You know, I would do that. I would look to buy, if you're in a covered call right now on Apple or on Facebook. Sure, you're going to miss the upside. If it moves up, you might get a sign and get the return you want, but if it falls down, then you might have a large risk. Okay. Okay, this goes back to CL. Do I still have that chain up? I'm sorry. Jagad's question said, on the 79 call, would it be buying since there's only 72 open interest? Yeah, it could be. Like I said, I mean, I might enter a straddle right now in a stock that comes up with earnings. I might only buy 2 or 3 contracts. That's not one person. The 72 open interest is not one person. It's a whole bunch of people. You don't know what that open interest, you don't know the 72 interest is just buying. Okay, it's opening. All right. And Sam says, yeah, it's all about guidance, going back to that. Okay. Oh, okay. All right, Sam, thank you. I forgot about that. Yeah, Dorsey owns Twitter and SQ, and last was at 14. Okay. And you're right, Pascal. Volatility won't remain the same during earnings. I tried to show that I know I'm overpaying into it. I have to overpay into it because I need this, and volatility is going to change. Again, that's why I'm saying that I expect or I need 7 to 8% movement one direction or the other in order to profit. That is helping me take into account the volatility crush that I'm going to suffer. That's what it is. Okay. Implied volatility, that webinar I mentioned, implied volatility, the double-edged sword. Sometimes it's okay to pay into higher implied volatility if you're expecting a bigger move. Okay. Okay. Now Sam feels Sam's opinion. I'm not going to say it's my opinion, although I have a lot of conversations with Sam, and I respect Sam and what he does and how he trades and everything along those lines. Sometimes it's a little bit more involved than I would do, but that's to each his own. And Sam's very active and very aggressive. Sam made a comment at some point when we were talking about Facebook and Apple. His personal opinion, not mine. And I'm not going to say my opinion because I can't, because I can get in trouble for it. Sam can't. Sam says Sam feels they are too extended and they're pretty volatile. So he's concerned with Apple and Facebook that, you saw Netflix is at 147, dropped to 138, today's at 153. So he's maybe thinking around the same things along the lines with that. But he didn't have any position with that for the earnings on Netflix is what he wanted to mention. Okay. All right. So I wish I had the perfect answer for everyone. I really do. And I know what you want me to give you is the perfect answer. You want me to give you a strategy where you're going to be selling premium that has the highest implied volatility and is overinflated across the market, and show you a way that you can trade 1 or 2 options against it without giving up more than 20 or 30% of the premium you just received, and still push you in a directional trade where you can profit if the stock collapses or the stock moves up. I don't have it. I would show you. I would show you right now. I would have a webinar on it. We saw the combinations I tried to construct to take advantage of this. It doesn't give you what you want for the expectation of a swing one direction or the other. Could you get advanced and try to do 8-leg as 9-leg trades to find that? Maybe, but I still think you'd end up with the same outcome. You're not going to like what you see. I like limited risk positions. I do. If I did a married put with earnings coming up for SQ as we showed, I might add the 2 puts to create that V, and then after May 10th I'd manage it based on what I had left. If I was doing a straddle or strangle on Apple right now, based on my account size, I might only be buying 2 contracts, maybe 3 contracts, or if I went with an out-of-the-money strangle that was lower priced, maybe 4 contracts. But again, I know that I need a 7 to 8% swing. I know, and all of you know, Isaac and Pascal, I am going to suffer that volatility crush because I'm not playing that. I'm playing that the movement on the stock from earnings based on how the market has been and what I feel the stock's going to do is going to counter that. Volatility crush is a pain, but in order to take advantage of a swing, the market knows everything we do. We know earnings are coming up. We know it could jump up 10, 12, 15%. That's right. Okay. Oh, and hey, Jagade, it brings up a beautiful point. And this is usually something I would say, and I'll explain why I'm not saying it. And I'm sorry if I'm mispronouncing it. Maybe Jagade or Jagade. It says, sounds like to me that there is lower hanging fruit than trying to guess earnings direction, so why take the risk? Thank you. I agree. Like I said, I would never trade a bull put credit spread, a bear call spread, selling into premium with earnings to take the risk of having that go against me or volatility crush. I'm playing with this strategy that we're talking about. I'm trying to develop something that a customer asked me to do, and I've been playing with my personal account, buying 2 to 3 day out straddles on stocks that have earnings for a low cost. So Apple earnings next week, I wouldn't go past the 5th of May. I'm also not going to pay more than $600, $700 into the position. If it doesn't move, the volatility collapse happens, and I lose $600, I'm okay. I've had success, a 60% gain on Adobe with this strategy on a 3-day trade, trading the weekly when that expired on Friday with the Wednesday expiration. It was Adobe, Nike, PRRGO, Perigo, not eBay, it was another one. eBay I lost 20 cents on, but it was 15% of what I had in the strangle at the time. So I'm just trying to develop a strategy with a very low amount of money so I can pass it along to everyone else. But you're right. Why take the chance? If I'm trading covered calls, I never have a covered call, which I don't anymore, but I never have a covered call open through earnings. I never have a short call on my calendar spread open through earnings. I close the short call before and buy a put to create a strangle and then decide if I'm going to do a calendar put or a calendar call after the earnings and after I see the effect. So Jagad, thank you. You have the wisest answer I think possible, that in a lot of positions, yeah, we all want to hit this home run, but at the same time, you could lose money or not nearly make enough money as you expect. Okay? And that's the key. All right? Pascal says, can you really make a living trading? 40,000 available. What do you need to live on per month? My answer is no. My answer is no. Here's why. If I have 40K available to trade, okay, what do I need per month to live? Mortgage, everything else. It's around $4,000, okay? 10% per month, not going to happen. 10% per year is more of a target goal, honestly. I know you see strategies out there where you've been taught or you've shown an advertisement where you can make 20% on 5-day credit spreads with an 80% probability. Guess what? If you've got spreads that have an 80% probability, you actually need to be right 90% of the time to profit, because one trade will wipe out 9 previous losses. That's how you get the 80% probability. You're so far out of the money, you're looking to make 20 cents to risk 2 points. I trade 10 positions, one goes against me, that 2 points just wiped out the 10 premium. Pascal, so what's the solution? What do I keep saying that I trade in my personal account? Slower growth? Control risk. That's the only thing you can control in the market. That's why I trade with married puts and collars, and if I do something risky like a straddle or strangle, I don't invest more than probably 2 or 3% of my total portfolio value. Okay. Martin brings up an interesting question, and I'm going to answer it. Well, I answer all questions. Martin says, Martin has heard me before. He knows that I trade and I teach radioactive techniques. He knows that he's heard me say I trade it with 50 to 60% of my account. And he said, but since the married put position defines loss, and it doesn't guarantee upside, but it guarantees unlimited upside at the start. I mean, you have unlimited upside at the start. Why do any other trade? I'm 41 years old. I'm an options educator. I have to have the answers. What's the best way to have the answers for you guys when you ask me these questions? It's to have actually traded them. Not just theory, but to actually traded them. Yes, I'm trying to develop something that's fun on the side, but at the same time gives a good profit if I can develop something for short-term straddles and strangles around earnings. At the same time, I'm comparing every trade I'm entering on this idea, Martin, with these straddles to what if I had bought the 3-month out straddle, 3-month out strangle, 6-month out straddle. What gives the best long-term gains? This is part of my job, is to not actually trade it, but to actually develop it and then back test it, okay? Why do I still do calendar spreads? I like the idea of calendar spreads, but they're a different approach to me. See, the married put puts me in the proper structure that I want. It controls risk, and it gives me the unlimited upside, and I have the ways to adjust it. But sometimes I look at a trade and I think, you know, that looks like a pretty good stock. I don't think it's a long-term play that might give me 10, 15, 20% growth over a 6-month period, but I think it's a good 4%, 5% in 30 days. That's when I'll do a standard collar. I'll buy the stock at 50, sell the 50 strike call 1 month out for maybe a 2.5% if assigned, and then buy, let's say, the 47.5 put for 40 cents. So I give up some of the upside, but I still can make 2% if I'm right and only lose 3% if I'm wrong. It's just a 30-day trade, and I'm comfortable with that. The reason I do that is because I've been trading that for about 12 years, 14 years, I think. Yeah, 14 years now. I'm trading collars, and I'm successful with them. I'm more successful with married puts. That's why it represents 50 to 60% of my trading account as well. Okay. Yeah. Okay. Oh, Isaac, I don't really have a great answer for you. Okay. Isaac said, following up, yeah, and then sell short calls against the position. I may sell short calls. Martin, going back to the married put idea, the biggest gains that I've given up trading married puts have been from selling calls. I probably would have done better over the 7-8 years had I never sold a call against one of my married puts. I'd have higher returns. I could say that. All right. Isaac says, you said you need 7 to 8% on a straddle or strangle. How do we know this is going to happen? You don't. That's why it's a gamble. It's a lottery ticket. That's why I don't put more than $600, $700 into it of my trading account, maybe even less. Most of mine are around $400 total cost to $300 total cost in the straddle. So am I expecting to make hundreds of thousands of dollars? No. I'm expecting to get a jump and see a 30, 40, 50% ROI on that particular trade, and that's it. And we're not talking a lot of money, okay? So how do you make a lot of money on the straddles and strangles? It's hard to. It really is. You said, for example, SRP expected me was 20% and IV was over 100 and the stock hardly moved. Who expected it to move 20%? I didn't. I didn't look at that. When I'm trying to evaluate a position that I think might move 7 to 8%, what I do is I find it on the specific search that I'm developing. And what I do from that point, is I go back and look at the stock chart. And I look at the chart. It's a guessing game. I look at the chart and it says over the last 4 earnings or so, have at least 2 of them moved in one direction by at least 7 or 8%. If yes, then I might go forward with that one. If no, I might not consider it as a potential to move 7 to 8%. And that's the key. Okay, two more quick questions here because we are past time. Pascal said, what's the solution? I answered that one. Yeah, controlled risk, the one thing you can control. And Pascal said, so you make a living trading full-time? Like, no. I get paid by PowerOptions to do customer service, answer emails, answer phone calls, do webinars, write articles. Essentially, my job description is a technical writer. That's my day job. And then on the side, I'm able to trade my account, and my goal with these strategies is to see about 10 to 12% growth per year, which I think is phenomenal. Those people who teach you these, advocate these buying calls of 300%, 400%, 500%, you look at their true track record of closed and open positions, they're probably averaging about the same, 10 to 12% per year. Some of you have probably had a really good last 12 months with the way the market's moved without considering the hiccup from last January and February. You might be up 20%, 18% trading covered calls. You're not going to be up that in the next 6 months. It's not going to continue. It's give and take. So I think a reasonable expectation is 1 to 2% per month, factoring in winners and losers of all strategies, aggressive, non-aggressive, and so forth, and better than you can get at a bank and anywhere else. I'm sorry. Patrick says, I have 4 to 5 married puts with the stock. Have not gone anywhere for about 3 weeks. Since I haven't done married puts in the past, I'm getting a little impatient. Yeah. Okay, and you mentioned Facebook, but again, Patrick, I don't know if I would have sold a call before the earnings. I would have waited till after. And you're entering earnings season, so you're going to see a lot of those too. Okay, all right. Okay, real quick here. Martin wanted to follow up on credit spreads, okay, and he says, no, wait. Would you elaborate on what you just said? When you have an 80% success rate, the odds aren't as good as that sounds. Okay, I'm not saying 80% success rate, Martin. I'm not saying 80% success rate at all. I'm saying that investors who trade these credit spreads, out of the money bear calls, out of the money bull puts, one thing they might want to look for, of course, and we're going to look for it right now. We're going to look for standard May expiration very quickly. Okay. I'm going to go just, minimum 1% of the money, but I'm going to look for an 80% probability or better. But I still want a reasonable premium. So I want my net credit to be at least 25 cents. I want my percent return to be at least 9. Okay? All right. This is just a simple exercise in math. A lot of results there. Pretty good. All of these have an 80% probability or higher. So here's one here on NVIDIA. I don't like it. I'm going to make one more change. I'm sorry. I want to keep it simple, so I'm going to set my strike differences equal to 5. I don't want to mess with these 1.5s and trying to do the math and everything there. Let's just do a 5-point spread. Tesla, let's stick with it. Stock's at 314. We could sell the 290 put and buy the 285. 5-point spread. This isn't the one I wanted. I'm sorry, folks. I'm going to do this one. They're all 80%, but that's right at 80. Okay, well, we'll do this one. I'm going to take in a 74-cent net credit on a 5-point spread. Okay, so this is a little higher than normal. The average is usually here at about 50 cents in a 5-point spread. Let me do that one. I'm sorry. It's still 80% probability, but let me do this other one. This is typically what you see. Okay? When you look for an 80% probability, what you typically see is an 11.1% return, 10 to 11% return. That's why I put the 9% in there. Okay, but here's Goldman Sachs, I'm sorry. 215 by 210. This is not a recommendation because these probably all have earnings coming up, which I wouldn't trade a spread on. I didn't filter for that. I'm just showing an example. So bull put credit spread at 215 and 210. I'm taking in 50 cents on a 5-point spread, which means my true risk is 450. Okay? Now, I open 10 positions with that same risk-reward ratio with an 80% probability. Okay, GS already had earnings. Thanks, Sam. But still. Okay, so maybe I would do this trade, but this is not a recommendation. That's the important part. All right, so I do 10 trades. What do I take in? I take in $5. Total net credit. 50 cents times 10 trades, $5, whatever number of contracts, okay? Now, it's probability 80%. My risk is 450 on each. So let's say at the end of expiration, 9 trades expire worthless. 1 trade goes against me for the full loss, and I have to pay back 450. Well, I made a profit. I made 50 cents total instead of the 5 because I had to pay 450 back. All right? So I'm right 90% of the time, and I have a profit. If 2 go against me for the full loss, I lose 9 points. I was right 80% of the time, and I'm down $4. I lost money being right 80% of the time. That's what I was referring to. Having an 80% probability with a common structure that you see is about 11% return, so maybe 25 cents on a 250 or 50 cents or 10 cents on a 1-point spread. If all your positions are in that 80% range, you can't afford to take the full loss on any, but your win-loss ratio needs to be 90, not 80, in order to profit long term. Okay? That's what I'm talking about. Isaac, yeah, well, Isaac says, married put involves buying insurance with the hope that the stock has moved up beyond the debt to break even. Basically, it's a bullish assumption. Yeah, the basic profit and loss chart is bullish by itself. I don't just open a married put and leave it alone. That's why we use the 12 different income methods. Some of the adjustments are used if the stock moves up, some are used if the stock stagnates, and some are used if the stock falls in price. I have a stock right now that I'm down. The stock is down, I think, 18% from where I purchased it. I have a loss of only 4%, and I have a chance to manage it to where I could turn it to a profit if X and Y comes out, and it's still going to be down 14% from when I got into it. So that's what the radioactive trading does. It's not just opening a married put and hoping the stock goes up. That would be best. But I have ways to manage it in case the stock falls against my expectations or if it stagnates. Patrick, you and I are going to have a conversation, a coaching session or something later on where we talk about maybe what you could do with your married puts that haven't moved for you. Blueprint owners and subscribers, of course, can schedule the coaching sessions at any time. All right. Okay, so we're about 5, 6 minutes, 7 minutes past 6 o'clock. Those were all the questions that I saw coming in. Okay. And yeah, GS already had earnings. Okay. And yes, I did record this webinar. We're going to post it this weekend, Wesley. It'll be available for you. We'll let everyone know when it's posted. I'll either send an email out on Monday or I'll let everyone know this weekend when it's available. Again, where is it going to be available? On our webinars page. All the Friday discussions are posted in the free webinar section under the requested topics. So there's last week's covered call setup, options on dividend stocks, playing IV run-up for earnings, and more. Okay, so those are all our Friday discussions there, and we'll add this one to that as well once it's converted. Okay. Well, ladies and gentlemen, thank you for joining me today. Remember, if you have not done so, those of you that might be, those of you that just might be joining us for the first time at one of our presentations, just remember that at any time there, if you haven't done so yet, you can get a 14-day free trial to PowerOptions. Just go to PowerOp.com, put in your first name, last name, and email address. You'll have advantage of a 14-day free trial. And then we have subscriptions, different subscription levels after that, starting at $40 per month. And of course, on most of the subscription levels, a discount is available for the yearly rate. And of course, if anyone has any questions later on, just remember to send me an email at any time. You can reach me at support@powerop.com. Of course, if you have questions about radioactive trading, you can reach me at PowerOpt, or you can reach me at support@radioactivetrading.com. Also, give me a call anytime during market hours. You can reach us at 302-992-7971. And if I'm not available, of course, Ernie will be able to help you out, or one of our other staff members as well. Wow, that was a lot to cover. I might break this into 2 different webinars so it's not a full hour and a half long when we go ahead and post it. You'll have a 145-minute section. That's what I'm going to do. That's what I'm going to do. We had a good conversation at the beginning of this presentation. It took almost a half an hour, but it was useful information on some of the structure there. We did come back to it later related to the earnings, but I think I might split this into 2 separate webinars and let you know when both are available. All right. Well, ladies and gentlemen, thank you very much for joining me. Have a fantastic weekend. We'll see you next week. Back in the trenches, back in trading, as we all talked about today. Big earnings coming up. We know Apple and some others are coming up next week, so it should be interesting to see what happens. So thanks all for your questions. Thank you all for teaching me and some of your discussion there on your approaches, and we'll see you soon. Good night.